You opened your portfolio this week and saw Bitcoin down 20 to 22% in rupee terms, while the Nifty fell only 4 to 5%, and gold barely moved. Now, before we let these immediate price movements dictate our next move, we need to pause. We must analyze this data through the precise financial lens that brought most of us here in the first place, the store of value concept. The entire Bitcoin thesis rests on it being the ultimate mathematically verifiable store of value. Now, as you look at Bitcoin's extreme price swings, the same volatility that caused 20 to 22% drop, and simultaneously compare it to the calm in stock markets, one thought hits you immediately. If it crashes harder than stocks, only rallies when stocks rally, and also gets an extra 4 to 6% kick from rupee volatility every year, then what exactly is the store of value advantage I was sold? That doubt is not FOMO or greed talking. It is pure mathematical. Here are the exact numbers causing that doubt. Bitcoin, 30-day realized volatility right now, 62% annualized. Nifty is at 16% while gold is at 14%. 180-day rolling correlation with global equities. The average is 0.68 with two separate spikes of 0.88, the highest sustained ever. This is the crucial continuity concern. When global stocks fall 10%, Bitcoin falls 20 to 25% on average. When global stocks rise 10%, Bitcoin rises 20 to 25% on average. Plus, you get an extra plus 4 to 6% swing every year just because the USD INR itself moves. So in plain English, Bitcoin has stopped behaving like a hedge and has become a 2 to 2.5 times amplifier in the secondary market. Bitcoin is failing the correlation test that defines a crisis-proof store of value. Gold's 20-year correlation with equities is plus 0.04 only. Compare that to Bitcoin's today's plus 0.68. So your worry is 100% mathematically legitimate, and we accept it completely. No excuses, no zoom out cop yet. So now let us ask a question that actually matters for a serious Indian investor. Question 1. Can Bitcoin protect my portfolio if equities crash in next 1 to 3 years? The 2025 answer is probably not. Correlation is simply too high right now to rely on Bitcoin as a crisis hedge. Bitcoin is currently behaving like a high beta tech stock. But the truly serious investor must immediately pivot to question 2. Will Bitcoin remain the only liquid, verifiable, non-sovereign asset whose total supply is capped forever at 21 million units, while every fiat currency, including the rupee, continues to be printed at 6 to 12% per year? This second question is completely independent of short-term correlation, volatility, or VIX spices. It is rooted in fundamental, immutable scarcity. So let's review the scarcity schedule, which is a mathematical certainty. Coins that can ever exist is 21 million. Still to be mined is 1.67 million, about 8% short. And annual supply growth from 2025 to 2028 is 0.82%, 0.41%, 0.2%, and near 0% in 2028. Contrast this with the reality of our domestic currency. Indian M3 money supply 20-year average. It grows at 11.8% per year. The rupee loses 6 to 7% purchasing power annually and has lost it straight for last 34 years. So even if Bitcoin's correlation with the S&P 500 stays at 0.9 forever, that scarcity schedule that I explained earlier does not care about today's volatility. Gold needed almost 50 years after 1971 before the world fully repriced its monetary premium. Bitcoin is only 16 years old. Short-term volatility is an issue of market behavior. Long-term scarcity is a matter of code-enforced mathematical law. Let's bring this back to our spreadsheet and our family's financial security. Every Indian household faces 3 non-negotiable mathematical truths. 1. Guaranteed 6 to 7% annual rupee depreciation. 2. Post-tax fixed income real return, which is just about minus 0 to 1.5%. And 3. Physical gold carries 12 to 15% entry to exit friction, making it a poorer trading instrument. Against that unique backdrop, a disciplined 7 to 10% allocation to Bitcoin bought via monthly SIP on compliant Indian exchanges and moved to personal cold storage has delivered 178% CAGR in rupee terms over the last 10 years. Even if we haircut the next decade to a very conservative 20 to 25% CAGR, it still compounds to 6 to 10 times in nominal purchasing power. This is a critical mathematical outcome that no rupee-denominated asset has achieved without taking uncomfortable single stock risk. But with a great opportunity comes equal amount of risk. Now a necessary word about the impossibility of overnight riches. 10 lakh to 100 crore in one cycle needs a 1000x move. It requires surviving at least one 85% drawdown. So if you are planning an overnight rich in crypto, then it is not investing. It is a lottery outcome. Statistically, fewer than 5% of Indian crypto wallets have ever achieved it. And the vast majority of investors who chase such returns end up buying up in the top and selling in the bottom during the inevitable plus minus 80% volatility. The market has two components and they run on two different laws. One, the short term. Your doubt about hedging and correlation is valid and data backed. This is a behavior, it's a noisy failure for the store of value test. Two, the long term. The core thesis of scarcity is overwhelmingly in Bitcoin's favor. This is a permanent mathematical truth. Therefore, we must view today's volatility not as a bug, but as a mechanism to periodically cheapen access to that permanent scarcity. Mathematics, coupled with patience, will always win over any red candle. Volatility and correlations are loud, but temporary. 21 million Bitcoins is silent, permanent, and a mathematically fixed fact. Decide with your time horizon, your spreadsheet, and your family's 20-year purchasing power need. Don't react to today's red candle and use it as a disciplined opportunity to acquire a mathematical certainty. So that's all for today. Thank you for watching, and if you like this content, please like and subscribe to this channel. Also, please do check out other interesting videos about several other relevant topics. Thank you for your time and see you the next time. Bye.